All right, what's up? We're back with another Real Estate 101 video. My name is Daryl Williams, and today we're going to be diving into real estate terminology again. So, first term today that we're going to dive into is due diligence. Due diligence is a period of time when a buyer examines a home's condition and contract terms before become legally obligated to purchase. Due diligence is your time to discover and consider any financial risk associated with investing in a home. So now, in New York, we have co-ops and condos, and the due diligence period takes a little bit longer than if you were to do a single family or a townhouse. Right now, I have an accepted offer and it's been about almost 2 weeks and we're still in the due diligence phase because you have to reach out to management companies, you have to review business financials, you gotta figure out, is the building responsible for the terrace that's exterior, or since it's used by the apartment, do the buyers have to maintain that? So due diligence can be sometimes 1 week, super quick, sometimes 2 weeks, 3 weeks before due diligence is completed. And in that time period, you do your home inspection and all of that. So that's why due diligence period is important, because you want to know all the information up front before you sign on the dotted line and put down a down payment, which is our next term. Your down payment is the percentage of the home's sale price paid upon closing to secure your loan. You can typically avoid private mortgage insurance with a down payment of 20%. However, many lenders allow loans with smaller payments. Now, a quick thing about down payments. In New York City, the market that I sell in operates a little bit different. So the down payment typically is not, it depends on your amount. So for example, if you're doing 10% down in New York City for your down payment for, let's say, $800,000 two-bedroom condo, if you're lucky to find one at that price. At contract signing, you're actually going to put 10% down. So instead of a good faith deposit and then putting the down payment down at closing. That's just how we do it in New York City. The contract deposit is 10%. If you're buying into a co-op, the contract deposit is 20%. And there's really no negotiation on that. You pay that at contract signing, and then your closing cost is the only money you're bringing to the table at closing. So it just functions a little bit different here in New York City. Just something to be aware of if you're coming from a different market and you're gonna work as an agent, or you're in New York City and you're buying here for the first time, but you've bought somewhere else. It's very different in terms of down payment. Contract deposit is 10%. Sometimes it can be less if you're doing 95% financing, then you'd be putting 5% down at contract signing, but we don't do good faith deposits. Next, amortization. Now, if you're a buyer, this is very important for you to know what this is. It refers to the payment schedule outlining what goes toward principal and interest balances. Typically, payment goes towards interest first and then principal balance after. And obviously, if you have a 30-year mortgage, this amortization scale is over that 30-year period, or if you're doing 15 years, etc. It's pretty self-explanatory. Seller's disclosure. A seller's disclosure is a legal document sellers must fill out stating any home defects that may affect its value. Requirements on this vary state by state. But listen, that's why you do a home inspection first, because you find the defects before you even sign anything, and you're well aware of what's going on in the property, because most homes in New York City are sold as is, which means you can still spend $1 million on a property as is, and that property might need $200,000 to $300,000 worth of work. So you always do your inspection first to find a defect. If there's a big thing, you go back and you negotiate on the purchase price, or have the seller fix it, or just negotiate a credit at closing. I'm actually doing this right now in a deal. It might kill the deal, but who knows? All right, second mortgage. A second mortgage is, well, what it sounds like, it's a second mortgage. It's a loan taken out using your home as collateral. A HELOC, a home equity line of credit, is a common type of second mortgage. Obviously, you would do a HELOC when you have equity in your property, and people usually take this out to do renovations on their home. But if you want a life hack, if you have equity in your property, pull it out and buy it and use it as a down payment on another property, and rinse and repeat. Don't take it out and just renovate your primary residence and have a larger mortgage payment. But listen, you don't have to listen to me. I'm just saying, if you want to build wealth and then real estate empire, take the equity out and use it as a down payment on another one. All right. Lien. A lien secures payment by giving the lien holder a legal claim to the property. A mortgage is a type of lien because your lender can legally repossess your property if you fail to make payments. So make your payments so the bank doesn't steal your house. Or take back your house, rather. A lender. It's what it sounds like. A lender is a financial institution. Bank of America, Chase, First Republic, these are lending institutions that offer home loans or other credit lines. Also, a credit union can be a lender. A private money lender can be a lender. Obviously, it's in the title of the name, but these are different institutions. It's not just a bank. Okay, so there you have it. New real estate terms for you to memorize, have in your repertoire so you can sound really smart when you're talking real estate to a real estate agent or amongst your family, whatever. But now you know you have more knowledge to go out, crush it. Thank you so much for watching, and I'll see you in the next video.